Well, Morgan Stanley's out with a new bullish call saying the beaten-up Mag 7 names could be ready to rebound. Mike Wilson's the firm's chief U.S. equity strategist and chief investment officer. He joins us now. Mike, great to see you.
Good to see you, too.
So this is a tradable rally? For how long?
Well, it has been, I guess. Look, I think we're just marking to market with respect to, I think we came into the year a bit more worried about the first half. We had a range of sort of 5,500 to 6,100, and we hit the low end of that range. So, the fact that we bottomed right on that number, I guess, made us feel better that technical level was real support. But really, at the end of the day, I mean, everybody's talking about tariffs right now, but the reason the markets are lower over the course of the last 3 or 4 months has nothing to do with tariffs. It's mostly to do with the fact that earnings revisions have rolled over. The Fed stopped cutting rates. You had stricter enforcement on immigration. You have DOGE, which all those things are growth negative. And then tariffs is just kind of the final piece that kind of, got people really kind of bearish at the end. And I would say the thing that really got the S&P going down at the very end was when it became clear that the president does not care about the stock market, at least for now. And that lack of a Trump put was like really new news to people. So we felt like all of that sort of capitulation was good at 5,500. It started out with a low quality rally, which is what we expected, meaning a short squeeze. And then, what we noticed is that the revision factors on the Mag 7 are actually starting to stabilize a bit. So the last couple of days, those stocks have acted better, and that can take the index higher. Like how high? 5,900. So we're almost there. It's halfway done. I mean, the move has kind of already happened. I think the bigger moves are going to happen in these lower quality areas where the short base is still pretty stiff. And ultimately, though, I think I agree with a lot of the commentary you had on the panel there, which is that it's going to remain volatile through the end of the second quarter. So whatever rally we're getting now, we think probably ends up fading into earnings into May and June, and then we'll probably make a more durable low later in the year. A
durable and new low. Like we haven't seen the lows for the year.
Potentially a low. Let's put it this way. I think the chance of us making a new high in the first half is very, very low. Okay, could we make a new high in the second half of the year as people look forward to 2026? Yeah. Do we have to make a new low in the S&P 500? I have no idea. But what I can tell you this is that I think that it's going to be a trading environment at a minimum. Okay, that's their best case scenario between now and probably the end of June and into the summer. And look, that's why we're here on Fast Money. Our job is to be both. We have views on the long term and we have views over the short term. And our views in the short term, I think, have been pretty accurate.
Yeah, so Mike, you came out with that note this morning, but last week's note, so every Monday you come out with it, was also hinting to this. You were kind of suggesting the fact that some of the names that you really care about from an earnings perspective were kind of getting overdone to the downside. If you think of the Fateful Eight, they were doubling up the downside. Tim, they were doubling up the downside that we saw in the S&P 500. So on a day like today, it's kind of interesting when you see Apple, Microsoft, Broadcom underperform. Is that sort of price action, is that the sort of thing over the next few days, if we just don't see them continuing to participate, that you might kind of go to a more bearish stance?
Well, there's dispersion in the Mag 7, Faithful 8, whatever you want to call them. I mean, half of the group was
Don't encourage
quite,
him, Mike. Okay, go ahead.
Half of the group was quite positive today. I mean, Tesla had a massive move. So, I think the barbell to own right now for this trade has been Mag 7, but also low quality, and that's what this is kind of reflecting. I don't think the market's trading off of fundamentals. Across. It's more about technicals. It's more about the flows. Where the short base is greatest. But the one piece that we felt good about this week was that the Mag 7 or Faithful 8 revisions are starting to sort of bottom out a bit. And the other trade that we advocated this week was that the U.S. could have a relative move back against Europe, because as we go into second quarter earnings, right now with the dollar weaker, that's going to be a headwind for European earnings and actually a tailwind for some of the larger cap names in the U.S. Look, these are the trades that, this is what we're being given, right? So we have to take advantage of these trades when we see them.
Hey, Mike, it's Tim. So it sounds like you're a little more negative on the MEGA trade, and that's making international great again. But my question for you is, what part of your view here is somewhat non-consensus? Or I'd be just curious to know, which of these subsectors do you actually think we're really going to have some impressive earnings growth? I mean, the energy sector is one of these places, too, where I think you really have seen some non-correlation, some surprise resilience, and actually some earnings growth. It's not a big deal, probably, even to someone like you, because it's 4 to 4.5% of the S&P. But tell me about healthcare. Tell me about which also looks like it's really had a nice recovery off of some fundamentals and some headlines that were not so good. Help us drill a little deeper than just this is a trading rally.
That's right. I mean, on a more core basis, we've been very focused on earnings revisions where they've been good, and that's been financials, some of the software stocks, consumer services still look pretty good, and of course, some of the media entertainment area, not the ones people are excited about, but more like your telcos and cable companies, quite frankly. And then energy has been a group we've been overweight. It's finally working now here this year. Healthcare is very idiosyncratic, as you know. So it's a mix. It's a real mix, and it's more idiosyncratic. I think what I can tell you is that our work suggests that you still want to stay up the quality curve for your core portfolio. What we've been talking about the last couple of weeks is more of the trades that we sort of like in here. But those four groups I mentioned before: financial, software, consumer services, and some of the media entertainment. Those would be the core of our portfolio right now from a revision standpoint. And then we'll be looking for parts of the market that can benefit into 2026. I think it's a little premature for areas like energy and materials to have a sustained move because I'm not really a believer yet in global growth accelerating. But those are two areas that I think could have a really good second half of the year.